Hey, finance aficionados. Get ready for a whirlwind tour with Arthur Hayes on Podcast Nuggets. Brace yourselves for a bull market, potential financial crisis, and the crypto boom. Is your portfolio ready? Bond markets, bank term funding program, and a rubber band analogy. We're decoding the complexities of a banking crisis and sovereign debt shift. Subscribe now, hit that like button, and join us as we navigate the future of finance. Let's dive in with Arthur Hayes. Arthur Hayes predicts a massive bull market in stocks, real estate, and crypto, leading up to a major financial crisis, possibly worse than the Great Depression, by the end of the decade. The global reliance on Keynesian economics has led governments to intervene in markets during crises, causing distortions. Central banks have destroyed free pricing mechanisms in various sectors, except the government bond markets. A rising global debt of 360% of GDP is unsustainable, driven by a declining population in the rich world. Governments resort to printing money to sustain the system, risking a generational collapse. Human civilization's progress is linked to hydrocarbons, lack of innovation in alternative energy sources, and declining populations hinder the ability to grow out of massive debt. Printing money is not true growth. Historical examples show that it leads to massive inflation, social unrest, and collapse of governments. Political instability arises from Western policies against Russia, creating a divided Eurasia. Conflict with Russia impacts global energy prices, contributing to inflation and the impending financial crisis. A proxy war between Russia and the West, focusing on Ukraine, suggests that World War III has already begun, contributing to the geopolitical backdrop of the financial crisis. Unsustainable promises made to baby boomers regarding healthcare and defense spending create a financial burden. Political reluctance to reform these sectors exacerbates the economic challenges. Global energy demand affects inflation. The global competition for energy resources, driven by countries wanting to meet their own needs, contributes to inflation. Government's role in banking. The banking system is crucial to fund the government, and during financial crises, governments tend to print money to save the banking system. Debt to GDP ratio and defaults. Historically, when a country crosses 130% debt to GDP, default becomes inevitable, leading to currency depreciation, financial repression, or government bond market default. Money printing and inflation. Increased money supply without a proportional increase in goods/services leads to inflation as the value of money decreases. Treasuries and buyer issues. Traditional buyers like China and Japan reduce holdings, impacting the ability to roll over massive US debt, potentially leading to a financial disturbance. Bond yields, gold, and perceived risk. Rising bond yields suggest a lack of faith in government debt being risk-free, challenging the traditional relationship between bonds and gold. Bond market challenges. Bondholders are losing money due to rising yields, making bonds less attractive compared to alternative investments like gold amid uncertainty. The US government is currently spending around 34% of its budget on interest payments, reaching about $1 trillion annually. Long-term bondholders face significant risks when interest rates rise, impacting banks like SVB, First Republic, Silvergate, and Signature. The Bank Term Funding Program, BTFP, covers banks holding eligible securities, U.S. Treasury bonds and mortgage-backed securities, but not commercial real estate loans. The U.S. government's choices include a banking crisis or potential inflation crisis due to $4.4 trillion liabilities from the BTFP. There's a banking crisis as people move deposits from smaller banks to larger ones with a guaranteed deposit. The BTFP doesn't cover regional banks, creating uncertainty. The BTFP covers specific assets, and excluding certain loans, for example, commercial real estate, raises questions about potential insolvency in the banking system. Inflation is described as an invisible tax, reducing the value of money. The government faces a choice between making everyone cover losses or letting certain entities fail. Financial crises traditionally happen in the fall and winter, and current issues are known but not receiving full market attention. Known problems include U.S. banking insolvency, reduced global growth from China's real estate issues, and Japan's dilemma in managing its government bond market or currency. Arthur Hayes suggests that the current crisis has shifted to sovereign debt markets. The potential trigger is when buyers refuse to purchase long-end bonds due to concerns about repayment in real currency. In response to a bond market revolt, authorities may resort to fiscal dominance or yield curve control. where central banks fix bond prices by printing money to prevent yields from rising. The crucial aspect of the crisis is whether individuals can move their money outside the banking system to maintain purchasing power. If money is trapped in the system, governments can tax citizens to address the situation. Japan's unique success is attributed to its closed banking system, substantial assets, and historical labor and economic strategies, which differ significantly from the situation in the United States. Comparing the United States to Japan, Hayes emphasizes the fundamental differences in their financial situations, especially the U.S. reliance on foreign ownership of debt, current account deficits, and budget deficits. Constructing a portfolio involves a barbell strategy with high volatility assets for potential upside, for example, crypto, tech stocks, and breaks, cash, short-term instruments, for stability and covering day-to-day expenses. Hayes suggests having an optionality portfolio that minimizes costs while waiting for events to unfold, making sure it's low cost or profitable even if the anticipated crisis doesn't happen immediately. Successfully navigating volatility involves staying emotionally composed, avoiding buying high and selling low, and considering personal preferences when selecting risky assets within the portfolio. For inexperienced investors, diversifying into broad, low-risk assets like S&P or AI growth stocks can be a safer strategy. Time span matters in investing. Day trading requires constant attention, while long-term investments demand patience. Anticipating a financial crisis in 3 to 6 months, preparing for money printing, and investing in high volatility assets like AI-related stocks are strategies. AI and crypto, especially companies and technologies related to AI, are expected to experience a significant boom, combining money printing and technological innovation. Transitioning funds from high-interest money market funds to AI and related sectors when rates decline. But timing the market is cautioned against. Central banks are transparent about monetary policy changes, providing signals for investors. Patience is recommended instead of trying to time the market. Given historical examples, the speaker views the consensus of a soft landing in the global economy as improbable. Considering the unprecedented global debt. Reflecting on the 2020 to 2021 crypto rush, euphoria is recognized as a key indicator. The speaker monitors euphoria as a disciplined investor, entering and exiting strategically. Arthur Hayes emphasizes the challenge of AI investments, requiring long-term vision due to liquidity cycles. Investing in AI startups today may mean waiting until 2026 to 2027 for liquidity. Hayes stresses the importance of having liquidity in AI and crypto investments by 2025 to 2026. To avoid being caught off guard when market sentiments shift, being able to liquidate assets promptly is crucial. While optimistic about AI's transformative potential, Hayes warns against the euphoria, emphasizing the need for tangible results, revenue, and user adoption. Liquidating investments becomes challenging without these proofs. Hayes explains the potential scenario leading to a Great Depression, involving excessive money printing, energy crises, and social unrest. He highlights the vulnerability of fiat systems. Discussing potential conflicts, Hayes views modern warfare as extending beyond physical borders, involving cyberspace and data ownership, rather than traditional territorial disputes. Hayes downplays the impact of dollarization on the average American, stating it primarily affects the financial elite. He suggests the U.S., with its resources, can still sustain itself even if the dollar weakens. Europe is seen as high risk by Hayes due to energy and food insecurity, potentially leading to internal conflicts. He questions the sustainability of the euro construct, especially in the face of diminishing resources. Hayes emphasizes the revolutionary aspect of cryptocurrencies, providing a violence-free, opt-in financial system. The ability to hold wealth privately and escape traditional banking systems is highlighted. Hayes advises obtaining financial freedom through crypto, enabling individuals to choose communities aligned with their values. He suggests choosing a place with rule of law, where people treat each other well. Cryptocurrency allows speculation, but caution is advised. Speculating on a future system's success is different from day-to-day survival. The recent crypto crisis showcased the resilience of the decentralized financial architecture. Despite losses, the system functioned without a bailout, highlighting its strength. FTX, though regulated globally, faced malfeasance, challenging the idea that regulation alone prevents scams. Financial regulation may not deter bad actors or prevent large-scale losses. Future generations may naturally adopt digital money. But the debate arises about the balance between digital convenience and financial privacy. CBDCs may offer convenience but conflict with the essence of freedom. Embracing crypto through ETFs might introduce traditional finance players, potentially altering the privacy and decentralization aspects. The entry of large institutional ownership raises questions about the future ethos of Bitcoin. Attempts to control or dictate the culture of crypto may backfire, as true culture emerges bottom up. The essence of Bitcoin lies in its resistance to control, and attempts to dominate it may undermine its core principles. Arthur Hayes predicts Bitcoin will fluctuate around $25,000 to $30,000 in 2023. Anticipates reaching $70,000 by the end of 2024 due to potential financial crisis or negative real rates. Expects a significant crypto bull market in 2024, with Bitcoin potentially reaching $750,000 to $1 million by 2026. Driven by events like crypto happening and the launch of ETFs. China's stance on crypto. China didn't eliminate crypto but made it hard to trade due to concerns about social stability. Hong Kong, being part of China, may experiment with crypto under controlled conditions. Hong Kong's positive approach. Hong Kong government supportive of Bitcoin. Licenses issued for crypto-related activities. Seen as a test bed for financial innovation and controlled experimentation. Global perspectives. Discussion on the unease of government control in crypto. Comparisons between free systems and controlled environments like Hong Kong. What if they're wrong? Scenario if global issues are solved, acknowledges potential for a soft landing. Considers risk-adjusted returns in different scenarios, challenging the need for holding stocks. Conditions for no looming crisis. Discusses conditions that could signal the absence of a financial crisis, including reducing debt to GDP and effective management of the economy. For the full podcast, check out the link in the description.